become quite complicated now, right? Because everyone has been talking about the market for equities, and then we talk about the fixed income market. And nowadays, people have started to build up a lot of interest into this market of fixed income as well, right? So I'll be just talking about the current scenario of the fixed income market. And also, there were a lot of questions among the different connections on LinkedIn and through my different social media platforms. They wanted to understand that why this fixed income market has become too complex, right? Because everyone is talking about like which share to purchase in the market, or like which sector to buy, or like which sector to sell, or trying to take some derivative positions to hedge their portfolio. But when it comes to understanding the fixed income market, the fixed income market, something it tends to get very complicated at certain point of times. And it becomes very difficult to understand about the current market scenario and the fixed income as well. Right? That which fixed income to buy or which fixed income to sell. So, like more or less, the discussion would be on the duration and not upon the particular companies having their fixed income instruments, right? And I'll be talking about and taking into consideration the different aspects of the yield curve, inflation, the long duration bonds, the short duration bonds, the fear of recession, what to purchase, what to buy, because it becomes a complicated question when people tend to talk about the short duration bonds or long duration bonds. That is when to purchase the short duration bonds or sell the short duration bonds, or purchase the long duration bonds or sell the long duration bonds, right? What to do in case of rising inflation, and what to do when this case of inflation is at peak and the Fed is bound to reduce that interest rate, that whether to go for the corporate bonds or whether to go for the government bonds, right? So how like you guys can play through different themes in this particular market. So firstly, we need to understand about the different concepts as well, right? That when does the price of the short-term bonds rise, when the yield of the corporate bond falls, right? So all these scenarios we'll try to understand with a simple basic discussion. And we'll start this kind of discussion from 2022, where the interest rates were too low and inflation was rising. The prices of the commodities in the Indian economy, or be it the global economy, was rising, right? So we'll start a discussion from that point of time, and then we'll be talking about the different scenarios of the yield curve, why the yield curve was rising in 2022 and suddenly became inverted in 2023 and 2024, and the fear of recession came into place, how these things actually happen in very detail. And I can guarantee you that after the session, like you'll be able to understand the dynamics of the bond markets, the yield curves, and why and what these kinds of things play in the market, right? So very basic concept. So like just before we start with the session, so one thing you guys need to understand. So I'll be just sharing my screen as well. And very briefly, like I'll be just covering this point in just a minute or so. So like when we talk about markets, there is always a concept in markets like which is called as duration, right? So firstly, we need to understand that what do we mean by this concept of duration, right? So ideally, like when we talk about duration, duration is nothing but it is your inverse relationship, right? Your inverse relationship between the price of the bond and the yield. Just give me a second. Yeah. So if we talk about this term of duration, your duration is nothing but, just make a note of this point, your inverse relationship between the price of the bond and the yields. When the price of the bond rises, the yield falls. And when the price of the bond falls, the yield rises. So this thing we need to understand, and we need to understand this inverse relationship between the price of the bond and yield. And this concept is called as duration, because all the discussion would be further implemented upon this concept of duration only, right? So first thing we need to understand that what happened in 2022, the early parts of 2022, the mid parts or the year ending 2022. So what was exactly happening at that particular point of time? At that particular point of time, the interest rates were low, though the Fed had started to increase the interest rates. But let's try to begin and start the discussion with the starting part of 2022. Inflation was peaking, the prices of the commodities were rising, right? Because we came out of the COVID period and there was huge kind of a liquidity in the market. The Fed, the Central Bank of US and the Reserve Bank of India and the different banks of their respective countries, they flooded the market with money. They reduced the interest rate. They used to buy the bonds from the market through the open market operations, because when they buy the bonds, they give the money to the public. And again, that money gets circulated into the stock markets or buying different types of assets. Inflation was peaking and the interest rates were too low. So ultimately, a very simple concept, which even a school student knows right now, that when inflation is about to peak or when inflation is rising, there is always an expectation that the rate of interest in the market will rise. The rate of interest or the repo rate or the rate fixed by the Reserve Bank of India or maybe the Fed in US, because Fed is ultimately a global bank, I would say. And once Fed increases the rates of interest, the other banks also tend to follow the same line. So the simple concept, when there is a fear of inflation, the interest rates are bound to rise. So at that particular point of time, the interest rates were bound to rise in the market because they have to increase the interest rates, because if they do not increase the interest rates, the value of the currency will erode. Because there was huge money in the market and people were importing a lot of commodities also, because they used to find the imported goods cheaper as well, right? So on the result of all these factors, like what basically happened, the value of the currency was coming down. Until what point of time the Reserve Bank of India could save the Indian INR? They used to sell the US dollars like from the reserves, and the reserves also came down as a percentage of GDP. They were like 19 to 18% as a percentage of GDP, and they came down to around 15 to 16% of GDP, almost close to the 2008 financial crisis, and the forex to the GDP ratio was around 13 to 14%. That's 1 to 2% here and there, right? So whenever, and you need to understand this logic, that whenever there is an expectation that the interest rates will rise in future, so what basically happens at that particular point of time, when there is an expectation that the interest rates will rise in future, the people tend to purchase your short duration bonds. They tend to purchase the short duration bonds or go long on the short duration bonds, right? They tend to purchase the short duration bonds or they tend to go long on the short duration bonds, and they tend to sell off the long duration bonds. So here they are buying those short duration bonds and they're selling off the long duration bonds, because the long duration bonds are more prone to the interest rate risks. The prices of the long duration bonds are affected more by the change in the interest rates, and that we have seen in the case of the banks collapsing in US, be it the Silicon Valley Bank or the First Republic Bank. They had the long-term securities, the long-term held till maturity securities, which they had to sell, right? Because there was not enough money to pay off the people of the bank. And also because of the interest rates going high, the prices of these securities came too low, because the interests were risen by more than 500 basis points in one single year. Correct. So people tend to purchase the short duration bonds and they tend to sell off the long duration bonds, right? So when people are purchasing those short duration bonds, the demand of the short duration bonds in the market rises. So when the demand for certain commodity or a particular asset or a fixed income security rises, the price of the short duration bond will rise. And since people are selling off the long duration bonds, the price of the long duration bonds will fall. Since people, and I'll repeat this point, since people are purchasing the short duration bonds, the prices of the short duration bonds will rise. And since people are selling off the long duration bonds, the prices of the long duration bonds will fall. Now, since the prices of the short duration bonds are rising, and there is an inverse relationship between the price of the bond and the yield, the prices of the short duration bonds are rising due to the increase in demand, but the yield of the short duration bonds will fall. And vice versa. Since people are selling the long duration bonds more, the prices of the long duration bonds will fall and the yield of the long duration bonds will rise. And this will not happen overnight. It might take a couple of years, 1.5, 2 years, or 3 years. And this change will come into place like till the point of time inflation is almost controlled. Now here we can see, now here we can discuss about the one point. We can see currently in this situation, so what basically happened, we have a rising yield curve. There's a yield curve in the market that tends to state the people about the current macroeconomic conditions, how the economy is performing. They tend to give you the yield for different maturities on the yield curve. So this is a rising yield curve. It is giving you the yield at different maturities on the yield curve, and a rising yield curve is good for the economy because at that particular time, we can see the expectation is the rise in the interest rate. So as a result, the long duration bonds interest rate is priced higher. Why? Because people are selling off the long duration bonds. The price of the long duration bond is coming down and the yields are going up. But the short duration bonds price is rising, but the yields are going down, right? Because people are purchasing the short duration bonds and due to the concept of duration. So as a result, the long duration bonds have a higher yield and the short duration bonds have a lower yield. And this is a rising yield curve that shows prosperity and growth in the market with zero fear of recession or negligible fear of recession. So that was a state that people were assuming that came into the market at that particular point of time. Then, like what basically happens, inflation comes down. Inflation is starting to coming down, and people are expecting what? That the Fed or the Central Bank of India or the Reserve Bank of India. So let me just name one term. So I'll be just talking about Fed, right? In overall for banks. So Fed will be expecting, so people would be expecting the Fed to reduce the interest rates because inflation has come down. And also there is a fear of recession, a mild fear of recession, because if the interest rates become too high, the spending power of people will further come down and there won't be any expansion activities and diversification work, because ultimately people have to take loans, and if the rate of interest on loans is too high, it also hampers the construction activities, the real estate activities, the manufacturing activities, ideally, right? So this kind of a thought starts to play in the market. So now here, people are expecting that the yields will come down. The Fed will reduce the rate of interest, or the Fed will reduce the yields on the fixed income securities or the treasury bonds per se, the treasury or the government bonds, be it US, UK, or India, right? So what basically happens, the vice versa happens. In the first scenario, when people were expecting the interest rates to rise, they were going long or buying the short duration bonds and selling the long duration bonds. But now the expectation is vice versa, right? So now people are buying the long duration bonds and selling the short duration bonds. Why? So that they can lock in a higher yield at those bonds, right? They can lock in the higher yield at those bonds, even if the interest rates come down. But this is, I would say, not the end situation, because the expectation is there in the market, but the Fed might not pivot. And what do I mean by pivot? By pivot, I mean the Fed won't stop to increase the interest rates. The Fed might still maintain a hawkish stance. And what do I mean by the hawkish stance? I still, by the stance of hawkish, I mean inflation is still high, or either the Fed will increase the interest rates or they will keep the interest rates constant up to a certain point of time. And what do I mean by dovish? By dovish means the Fed might reduce the interest rates because they believe the figure of inflation is into a calmed range or into an acceptable range, like between 2 to 4%, or like 2 to 6% per se. Right? So that thing can be there. So what happens? People are expecting, but the Fed comes into the market. The Fed like comes on a news channel and there is a conference or the meeting of the Fed, the FOMC meet as we like popularly called it. And the Fed says that they're not that they are not like pivoting right now. They still maintain a hawkish stand, though they will not increase the rate of interest, but still wait to see the new numbers for inflation and the general market data. Right now, people who are expecting that the interest rates will come down in the next call, those people get hurt. So what basically happens? The long duration bonds that they purchase, anticipating that the Fed will reduce the interest rate in the meeting, they take the opposite position. They start to sell off the long duration bonds and again buy the short duration bonds, right? They again start to sell off the long duration bonds and again start to buy the short duration bonds because they felt that they were overbought in their long duration bonds portfolios. Since they felt that they were overbought in the long duration bonds portfolio, they again sold off the long duration bonds and started to purchase the short duration bonds. They might be selling off the 10-year, 20-year security and purchasing the 2-year, 5-year treasury bond on a temporary basis, because ultimately everyone wants to make money. And again, the bond prices might get shattered in one particular day. So at the end of the thing, or at the end of the line, with the fear of recession further comes into place, right? And the number for inflation also tends to come down. It becomes a natural expectation that the interest rates will come down finally, maybe in the next year. So what basically happens in that case? Your short-term rates are higher than the long-term rates because the future expectation is the rates will fall down. And currently the short-term interest rates are too high. So when the short-term interest rates are higher than the long-term interest rates, you have something called as your inverted yield curve. And this is your inverted yield curve that fear of a recession is there. The short-term yields are higher than long-term yields. So again, people tend to fear. And when there is a fear in the market, people tend to go towards a safe haven. And what is the safe haven? US dollar is a safe haven, ideally globally. Though you have the different currencies also, like the Japanese yen or the Swiss franc, but ideally the US dollar is a global safest currency. More than 55% of the trade goes in the US dollar or settled in the US dollar. So how people will get exposure to the US dollar? They will again start to purchase those bonds. They will start purchasing the long duration bonds of US. And once they start tend to purchase the long-term treasury bonds of US, the price of the treasury bonds will go up and the yield of the treasury bond will fall, right? Because again, the expectation is the yield will fall in the market as per the Fed also, right? So like what basically happens in this scenario, your short-term yields are higher than long-term yields ideally. And there is a concept which is called as yield spread. And second thing, which is something called as your corporate or credit spread. Some people say like both the things are the same, but both the things are not the same. Both of the things are different that you need to understand. You cannot synonymously use both the terms together. So what do I mean by yield spread? Yield spread is nothing but the difference in the interest rate of the treasury bond only. Here, the difference is taken between a long duration treasury bond and a short duration treasury bond. That is a government bond. Corporate bonds का difference नहीं लेते. Just take the difference of the long duration treasury bond minus the short duration treasury bonds. Currently, as of January 13th, when I am shooting this video, the thing is the long duration bonds are priced at 4%. And the long duration bonds, I mean the 10-year bond and the 5-year bond and the 2-year bond per se. The long duration bond, if I say, is priced at 4%. And a short duration bond is priced at around 4.4%. So this yield spread is negative. This yield spread is narrowing down. And when this yield spread narrows down, it's a fear of recession. It means economy might not do well. And when the yield spread narrows down, whenever the yield spread narrows down, the corporate or the credit spread, it rises. Why? And what is the corporate spread or the credit spread? It is the difference between two different bonds having similar maturity. The interest rates that two different bonds are giving having a similar maturity. That is, one is a corporate bond and one is a treasury bond. So in yield spread, you take the difference of a long duration bond ka interest rate minus the short duration bond interest rate. But in a corporate or a credit spread, you take the difference between a corporate interest rate bond, corporate bond interest rate minus the treasury bond interest rate. So that spread is becoming high currently. Because what is happening? When the Fed will reduce the interest rates, the corporate bonds or the corporate companies will still take some time to reduce the interest rates on bond. The interest rates on corporate bonds won't come down drastically. It will still take some time. And as a result, like what will happen? When the yields on the treasury bonds are low and they seem to be unattractive, people, apart from going towards the equity markets, they will also go towards the corporate bond market. And corporate bond market also can be a good play from a short-term to medium-term basis. So whenever the interest rates are falling, it is good to purchase the long duration bonds, but also we need to take some position in the short-term to medium-term fixed income to hedge our downside or the upside risk or in the opposite direction risk. So that we need to understand. And so that is very important because buying those bonds or buying those long durations bond per se is very good, but you also need to hedge if the interest rates fall down at a later pace. Because again, if the interest rates do not go down in January, February, March or near term, right? So what will happen at that particular point of time? The expectations would be heard. And when the expectations would be heard, these corporate bonds will give you a good exposure because those are the short duration bonds or the medium term bonds. And ideally in that scenario, when the Fed is not pivoting or the interest rates are still high for long, these short term securities might help you. And whenever a security is too risky, since corporate bonds are too risky, they offer you higher credit exposure. If you're going towards an HY bond, an HY bond is nothing but a high yield bond. So these short duration bonds will have a lesser amount of risk because the default in the long duration bonds is much higher. And as a result, these top investment banks, apart from going towards those long duration bonds, they're also emphasizing people to purchase those short duration credit, short duration municipal bonds, short duration corporate bonds, right? Or some mortgage backed securities, because again, the MBAs, they also carry the risk, which is accompanied or bundled together from the loan taken by different people. And in the long duration, these can be hurting, as happened in the 2008 crisis as well. So you can take a short position, or you can take a kind of purchase these short duration corporate bonds or fixed income securities, the mortgage backed securities, the private credit, the corporate credit, agency pass through. So all these things can be purchased on a short term basis to hedge that pivot wala concept, like which I just told you right now. So purchasing the long duration bonds currently is very fine, but also tend to have an exposure toward this short duration credit market as well. With a high yield market, investment grade might not give you a high return because that is a triple A quality. A speculative kind of for a high grade bond, and having exposure to the private market for the credit or the mortgage backed securities only on a short term basis because they carry that risk, right? And even the Europeans have started to purchase the US bonds. They've outpaced Japanese bonds. It outpaced those Japanese bonds in order to purchase the US bonds, because ultimately US is again a safe haven, and the Europeans, they want to de-risk their portfolio. And what do I mean by de-risking? They want to reduce the risk in the portfolio, especially for the various pension plans in US. And they want, because US is again a safe haven, right? So ultimately, these things we need to understand in a rising case for inflation, a rising yield curve, a falling yield curve, and when this kind of situation happens, right? Sometimes what happens, people tend to take a ratio of the treasury to municipal bonds, right? There's something, a ratio called a treasury to municipal bonds, right? Like sometimes happens, a treasury to municipal bonds ratios, and they tend to take the yield of yield of the treasury bond and divided by the yield of the municipal bond. So that is more common in US and not in India. So when this ratio is high, it states that the treasury yields are high and the municipal yields are low. And when the ratio is a smaller ratio, it means the municipal yields are high and the treasury yields are low. In that case, someone can take a buy or sell decisions upon the treasury and the municipal as well, right? Because currently the treasury yields might be far higher as compared to municipal, because these are the state government owned bonds or the central bonds, not exactly treasuries, but a second grade kind of a treasuries, right? So these things can be there. So treasury municipal, accordingly, if your rate of interest on treasuries is much higher and the municipal bond is lower, right? So what will happen if the Fed is reducing the interest rate? The interest rates on treasuries will go down faster than the municipal bonds. In that case, people can purchase the municipal bonds and get that high yield on municipal bonds, the same logic as corporate bonds, right? So these things we need to understand from a practical concept. Right? So these things are like very, I would say, like prevalent in the market, and you need to understand these factors as well. Any questions? This was a very quick session upon trying to understand, because I'm getting a couple of questions. So I will just taking up like new questions because we just have a few minutes right now. I just want to show you one thing, if that is possible. Any questions? So like municipal treasury ratio was something that you need to understand from a different perspective, because like that was something new for you all. Because ultimately what happens, a time would come, right, when the prices or the yields of these municipal bonds and the treasury bonds will coincide. Because there can be a limited amount of time till you can play this arbitrage, correct? But at a particular point of time, the yields of both the bonds will converge. So you can take a temporary position to like just to have an exposure to a particular fixed income and make return. Any questions? Yeah, Umesh, the concept for like treasury bonds is not so much like the concept of the municipal bonds is so much prevalent in India. It is more, though the municipal bonds are there in India, of course, but the concept is they don't tend to calculate the ratio between the municipal bonds and the treasury bonds. So that is more prevalent in USA, right? So can you please explain the difference between the yield spread and the corporate spread? Yeah, see, so one thing we need to understand, the yield spread and the corporate spread are different. Yield spread is the difference between the treasury bonds, a long duration treasury bond and a short duration treasury bond. The yield of the long duration treasury bond and the yield of a short duration treasury bonds. Here, both the bonds are treasury bonds only, or the government bonds. When the yield spread is narrowing or the yield spread is contracting, it means that might be a fear of recession and the economy might not do well. But when the yield spread is rising, as happened in 2022 early years, it means that economy might do good in the future. The second one is the corporate spread, which is also called the credit spread. It is a difference between a corporate bond and a treasury bond. Yield on a corporate bond and a yield on a treasury bond. So when this corporate bond or a credit spread rises or a corporate spread rises, it again indicates that a corporate bond is giving you a higher yield as compared to a treasury bond, right? So whenever there's a fear of recession or like whenever there's a fear that your economy might not do well, the yield spread will contract and the corporate bond spread or the credit spread will rise. That's a basic concept that you need to understand from a fixed income perspective. Got it? I guess Radhika had the same question. You guys can keep on posting your questions. I am just skipping the similar questions. You guys can come back to me on my LinkedIn, or like if you guys have my business WhatsApp number, you guys can contact me there as well. So I'll just share my business WhatsApp number as well, right? So like any of the queries, if you guys have, just feel free to contact me for like any of the queries on the fixed income market, or be it like any query per se for the stock market as well, right? So like this was a very quick session, a sudden session. And I would thank all the 750 participants for joining it in at a sudden short notice. Right. So thank you so much, guys. See you.